Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, new job numbers. The country picked up 370,000 jobs for June. And the stock market ended the week, all the indexes positive in the green. Are we finally near the bottom? We've got that and more tonight on this Friday, July the 8th, 2022. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday, July the 8th, 2022. I hope your week went well. Well, the Bureau of Labor Statistics released their monthly jobs report for June. And last month, we picked up an additional 372,000 jobs, and the unemployment rate for June was at 3.6%. Around the country, leisure and hospitality added 74,000 jobs. Healthcare picked up an additional 57,000, as well as retail adding 15,000 jobs for June. All the sectors were in the green for the month, and for the first half of the year now over, and as we begin the second half of 2022, how should we plan for our financial future? Well, coming up tonight, we're going to be talking with the managing director at Morgan Stanley, and he's also head of the Spiro Group, Jim Spiro. Jim has been a financial advisor for almost 40 years. Barron's Magazine has named Jim one of the top wealth advisors in the country, and Forbes Magazine has named Jim Best Wealth Advisor in Louisiana. But first off, how did the markets do this week? Well, all the indexes ended the week in positive territory, and the technology sector, which has been hammered for the last 6 months, was one of the S&P leaders for the week. This week, the Dow Jones ended at 31,339, and it was up about 0.75% for the week. And the S&P 500, they closed at 3,899, which was up about 1.2% for the week. And the NASDAQ, they ended at 11,635, up just over 4.5% for the week. Now, I know we must be getting near the bottom because analysts once again are issuing new price targets of stocks that have been hammered for the first half of the year. Bank of America has raised Apple to a buy with a new price target now at $200 a share. Well, let's get to our guest this evening. Jim Spiro is the managing director at Morgan Stanley. Forbes Magazine has named Jim as best in the state of Louisiana, and Barron's named Jim as one of the top wealth advisors and managers in the country. And best of all, he's here with us tonight. Hi, Jim. Welcome to Wall Street Wrap-Up.
Andre, thanks. Pleasure to be here. How are you tonight?
Do you think we're in a recession right now?
Well, there's certainly a denotation for a recession and a connotation. Denotatively, it's 2 consecutive quarters of negative GDP. In other words, where the economy shrinks. The total output of goods and services, GDP, shrinks. We were negative in the first quarter. Some of the anecdotal evidence I've been reading lately, including some preliminary estimates from the Atlanta Fed, suggest that we will have negative GDP for the second quarter. Denotatively, that would qualify as a recession. When the final data are assembled, probably in the next 8 to 10 days, you'll know whether denotatively we're in a recession. And my hunch is that that will be an affirmation of the connotative feel. So I think shortly you'll know whether denotatively, but it certainly has all the feel of it.
Do you think that the Federal Reserve, which in the month of July will be also, like last month, had raised rates, well, last month they raised rates 50 basis points, 0.5%. Do you think that they're going to have to raise rates again another 50 basis points or 0.5%? And if so, is their purpose, they want, as just what you were saying, is to slow down the economy to break the back of inflation?
Well, actually, Andre, in all the times I've appeared, this is the first time I'm one up on you. They actually raised it 75 basis points last time.
Thank you. You're right. You're
okay.
absolutely right. Thank you.
That's okay. You owe me a sandwich.
Deal.
But at any rate, I think the likelihood of at least a 50 basis point and more likely a 75 basis point increase in their meeting at the end of the month of July, I think is quite high. And I think that's attributable to a couple of things. One, Initially, they laid the groundwork for 50 basis point increases, and then when it became clear that they were just way behind the curve, that real interest rates were actually still meaningfully negative, they raised it 75 basis points, and they sort of communicated that another 75 basis point hike was quite likely unless things changed quite dramatically. I think if they were to revert from that now, they would begin to look a little flighty. Their credibility would be diminished. So I would think the likelihood leans more towards another 75. And then given the slowing in the economy, I think there will be additional rate increases, but perhaps at a slower pace.
Do you think that by raising rates and slowing the economy, this will actually have an effect on what the average person pumps gas in their tank every day for fuel? Is that by slowing the economy, gasoline prices will then drop, which will help the economy?
Well, gasoline, or better yet, crude oil, is a globally traded commodity. So there's a limit to how much influence, frankly, the Fed can have, how much influence President Biden can have. It's not insubstantial, but they can't control it the way some people might like. There's already abundant evidence of global slowing. In fact, the rate of slowing in the U.S. is actually less than you're seeing in other areas of the world. So gas prices, at least as you and I meet this evening, have already come off their high fairly meaningfully, about 25 or 30 bucks. And I think you will begin to see that reflected at the pump. And as a consequence, I think you will begin to see people pay lower prices. So in that regard, the prices will come down, but you must realize the prices are coming down because of the fact that the global economy is slowing meaningfully, and there's more and more evidence of a recession, not just here in the U.S., but globally. So you may be getting the desired result, but not necessarily because of the desired reason.
Do you think also that we're now in July,
right,
and we're finished up the second quarter, we're starting into the third quarter, which means companies that will be starting to report their earnings from the last quarter.
Yeah.
Now, with these new numbers, analysts estimate that they should be making whatever it may be. But I'm curious of your thoughts of, are they selling more products and services, or are they raising prices because of inflation, which creates it look as if they did better in the second quarter than they did in the first quarter?
It's a great question. Most of what I've read, and again, you won't know definitively until these companies start reporting, but a lot of them release sort of preliminary estimates, or you can listen to what executives say in various forms of media. Most of what I've seen suggests that revenues are growing, but the revenues are growing not so much because unit sales are increasing, but because prices are increasing, and those prices have to be passed along. So what you'd like to see is you'd like to see revenues growing because unit sales are increasing, rather than simply marking up the price, because when they mark up the price, eventually, for most products, there's some elasticity of demand, meaning the higher the price, people begin to back off purchasing. So I think revenues will continue to be pretty good. As to whether and how much of that flows to the bottom line, you won't know for a couple of weeks. But you raise a very good point. You'd rather see revenues growing as a byproduct of unit sales growing rather than the top line simply being jacked up, because that can only take you so far.
We haven't talked about it that much lately, but supply chain issues. I mean, there were supplies that, companies get some of their parts and goods from other parts of the world. Well, they're having supply chain problems, whether it be in China or Vietnam or wherever it may be.
Well, if you're referring to supply chain issues, I think they're beginning to ease. I think one of the reasons they're beginning to ease is because things have perked up in China. But that's a rolling sort of situation because they continue to cling to their zero tolerance policy. And as long as they do that and they enforce it, and I think they're likely to do both, until, or if not possible, then I think we'll continue to see it until we could either stamp out COVID and all of its permutations permanently. Absent that, I continue to think it's likely you'll see rolling supply chain issues with respect to Asia, from which we import a substantial amount of our goods. I would also say, though, that the supply chain issues are improving, again, largely because demand is starting to slow down. So all of these things are a byproduct of a slowing economy. You don't really like to see the supply chain issues improving simply because the demand is beginning to come down rather meaningfully, and there isn't as much pressure on the supply chain to begin with. It is improving, but I think, again, you're getting the desired result, but not necessarily for the desired reason.
Do you think CEOs of these companies that do use other parts of the world to supply their parts and services, do you think they're having rethoughts of maybe trying to get it closer, maybe not into the continental United States, but maybe whether it be in Mexico, Canada, or someplace that they don't have to use cargo shipping?
Yeah, I think they are. I think there's been a tremendous effort towards onshoring, and you read about that in a lot of goods. But you must realize that to some extent, a lot of these goods require, you look at all the electric car situation, a lot of those goods require various commodities that we simply either don't have in this country in sufficiently available supply, or there are environmental and regulatory reasons that are enjoining us from producing them. So lithium, cobalt, chromium, magnesium, a lot of this stuff comes from areas of the world that, that have the supply and we don't, or we don't want to have it. And even if we can onshore substantial portions of a final product here, we're still going to run into the same logjam when we have to import certain key minerals. The battery situation comes to mind immediately, when we have to import certain key minerals in order to make the finished product. So you improve the situation some, but we're not going to be able to become Fortress America. We're not going to be able to become an autarky where everything we can just take care of internally. It's just not possible. It's a big world, and to some extent we're going to have to rely on the rest of the world, and that's what it is.
Jim, that's a good point, because, I mean, the old saying of going from one frying pan into the other. There are many people in this country that don't want fossil fuels, or the oil, coal, and such. So they want to go into the battery and such. But with lithium, nickel, and other types of commodities, most come from countries that have always been our friends. So we're going to be more. Are we going to now be more dependent, going from a fossil fuel economy into the battery powered?
Well, as things stand now, and of course technology is always moving ahead in leaps and bounds, we don't have anywhere near the amount of capacity to produce batteries necessary to turn the fleet over and electrify it. We just don't. You're going to run into the same issue with solar panels. The president has been running into an issue right now with China, where he's relaxing tariffs to try to get more supply of some of the solar panels in here into this country. So you make a good point. A lot of these countries, if they're not our outright adversary, they're certainly aggressive competitors. But nickel, a tremendous amount of that comes from Russia. Lithium, I think the largest supplier of lithium right now is China. Some of the other minerals I mentioned, chromium, magnesium, they're heavily domiciled in countries in Africa that we have on sort of a no-no list, where we're very careful about importing goods from those countries because we're concerned that they use child labor or forced labor and so forth. So, again, a chain is only as strong as the weakest link.
There was an article in yesterday's Wall Street Journal where the Biden administration is now wanting to make first-time homes, more affordable for first-time home buyers and low-income buyers. Well, by doing so, they are lowering the standards to being able to get these people into homes, which in an overall sense, it's a very good, nice thought. But I remember back in 2007, 2008, with what they had was the real estate crisis. Are you seeing a deja vu all over again?
I think it's way premature to make that statement, Andre, but I think you have to weigh out practicalities with niceties. And generally, owning a home seems to promote a greater level of responsibility in most people. But that implicit in all of that is that the person has the capacity, or the people in the home have the capacity to service the debt, to service the mortgage that they've generally taken on. So I don't know what the future will bring, but the more we relax credit standards, the more we begin to revisit some of the things that we did years ago, and I guess you have to modulate the throttle. Now, I would say that banks are much better capitalized than they were years ago. The capital asset ratio is much stronger than it was 15, 20 years ago. The level of lending, I don't think is going to get anywhere near where it was 15 to 20 years ago. But again, there's a trade-off. And if you lower credit standards, you have to watch and make sure that you think you're not lowering them to the point that you're going to have bad loans.
normally there's a 30-70 or a 20-80 where the home buyer puts down 20% and borrows 80%,
right.
or 30% down, puts down 30% and borrows 70. And I'm going from this article yesterday was that they were talking about, or this earlier this week I should say, was that FHA will be demanding not a 20 or a 30% down, but maybe a 5 to 8% down. Now, that does still mean that they'll have skin in the game, 5%, 8%, but...
Well, it means they'll have skin in the game as long as prices hold. Obviously, housing prices are at or near all-time highs in most areas of the country. They've exploded, and that was another byproduct of the basically 0% interest rate environment we've been in. And I think that also was stimulated by some of the COVID issues where people wanted to get out of crowded areas. But yes, if you have if you have equity of 20% and the house drops a bit, you still have skin in the game. But if you buy a $500,000 house and you only have 5% of equity in there, if the house goes down 10%, which is not implausible, all of a sudden you have no skin in the game, and the bank is potentially underwater. So the closer you cut that down to zero, the less margin there is for error. And people, and I'm sure the lenders are, and I'm sure the federal government is cognizant of this, people should be mindful that the implementation of programs like these, and they have a potential good and potential, pros and cons, but the implementation of programs like these with housing prices at all-time highs, you have to weigh all of that out. That can certainly be beneficial, but you can see how you could paint a scenario where it could go against you rather rapidly. Yeah.
My also concern was, I remember back in 2008 when just as you were saying, when sometimes home prices reverse, where normally you have more equity in a home than you're owed, but when you owe more than the home is worth, there were some people that were just saying, well, I'm not going to fulfill my contract with the loan institution. I'm just handing the keys back, and it's on you. So that's where I was concerned.
Oh, I think your concern is legitimate, and that's the picture I tried to paint. No, that's a very realistic concern. If your equity is 5% and the home's $500,000, you got $25,000 worth of skin in the game. If the house drops 10%, all of a sudden, the bank's potentially $25,000 underwater, and there's certainly, I wouldn't say an incentive, but there's certainly an increased likelihood, I don't know how you could quantify it, that a person, that some people would come around to that point of view and say, the heck with my obligation, here's the keys, I'm out of here. And that's what we saw in 2008. You can see how some of the pieces in the puzzle could configure themselves that you could have a negative outcome. Yes, you could.
Yeah. If you're just joining us right now, so happy to have a good friend of the show, Jim Spiro. Jim is the managing director at Morgan Stanley. He's also head of the Spiro Group. Don't go away. We'll be right back. And we're back. If you're just joining us, we're talking with Jim Spiro. Jim is managing director at Morgan Stanley. He's also head of the Spiro Group. There are many people right now that are thinking about retiring or might have just retired and have decided to say, okay, now I'm going to live on my portfolio. There at one time was like a 4% rule.
Yeah.
And that was basically, and give or take, let's say you take 4%, how much should I retire? Well, you take 4% of your portfolio and you live on that for that year. And then the following year, if you have more of a portfolio, you might have more, or if it's less, you might have less. With these volatile times right now, first off, do you believe in the adage of the 4% rule? And what would you tell people of your clients that go, Jim, I'm about ready to retire. How much should I live on in my portfolio?
That question comes up daily, multiple times. The 4% rule existed for quite some time, but it had existed in an environment where for many decades, a person generally had a 60-40 portfolio, maybe 70-30, 60% in stocks, 40% in bonds, or 70 and 30, and so forth. But also you could get reasonable returns from the bond side of your portfolio. Throughout most of the 80s, 90s, early parts of the aughts, you could very reasonably get 4 to 6% out of a bond. Rates have perked up a good bit recently, but they're still historically extremely low. There are other considerations, Andre, that a person has to have when he or she retires. Number one, what's the status of the person's health? What kind of spending does the person have? What kind of Social Security does the person have coming in? It differs for everyone else. And then there are also emotional considerations. What are you going to do at the time? But the volatility point you make is an excellent point. If you have X dollars and you retired in the first year, supposing you retired at the end of 2021 and you had a 70-30 portfolio or a 60-40 portfolio, well, just measured by the S&P in the first 6 months of the year, the equity slice of your portfolio was down 20%. So, I'm not so sure the hard and fast rule that people are looking for exists. I think it has to be done on a case-by-case basis. I think the other things that I mentioned to you, health, Social Security, living standards, other sources of income, if any, have to be taken into consideration. I don't think you can produce a number anymore, given the volatility of the market, the low yields available on bonds, still from a historical standpoint, and say, I can set it and forget it.
You brought up an interesting point just now about a ratio of equities to bonds.
Yeah.
And talking about old adages or old thoughts, there used to be a thought, and I don't even know if you subscribe to this, that of how much equities, stocks, you should have in your portfolio. So you take your age and you subtract it from 100, and that should be your percentage. Such as, let's say if a person is 30 years old, they should have, which would be from 100, that's 70, so they should have 70% stocks to 30% bonds. And consequently, if you're, let's say if you're 70, that means 30 from 100, so you should have 30% in stocks and 70% in bonds. Do you subscribe to that? Or if someone would be thinking about having stocks to bonds, what would you ask? What would you subscribe?
Well, what I subscribe to is like Jack Benny. I just stay at 39, so I don't have to worry about that. I've never aged.
That's it.
Having said that, that too is a function. Again, it's not that I'm trying to be evasive. Quite the contrary. That too is a function of the person's predilection for risk, the person's resources, the person's desire to spend money, and so forth. Historically, Andre, stocks will deliver much more meaningful returns than bonds. You go back 30, 50, 100 years, you'll see the numbers are the same, somewhere between 8.5% and 9% over that time frame. But those are relatively long time frames, and you can get pockets where the market can be, quite an unpleasant place to be. The last 6 months is a perfect example of that. So what I generally suggest to most people is, as they age, to dial down their equity exposure. And I think that's particularly relevant these days, although the horse is a little bit out of the gate, because for the last 12, 14, 13 years, somewhere in there, we've been in an environment, with the exception of the first 6 months of this year, where interest rates were basically suppressed artificially by the Federal Reserve somewhere around zero. And the markets were reasonably placid, except for some pockets along the way, and generally had an upward bias. So because bonds produce virtually no return, and because stocks seem to be pretty much just a winning game, a lot of people came around to the point of view that there really was no alternative to stocks. So the general premise I try to impart to people is, as they get older, unless they are really dice rollers or they're unusually flush from a financial standpoint, it's worth dialing down their equity risk and accepting the fact that bonds will offer a lower return. But that's not where you make your real money on bonds. That's your cushion, and accept it as a cushion rather than as a money-making category.
Most people, if not most, have mutual funds rather than actual stocks in the stock market.
Yeah.
And fees are a normal rate of charging for whether it be for people's services. And I would imagine the psychology, and you talk to the average person who are your clients, they're going, oh, I want no load, or I want low fee. But sometimes the better the return, it depends on who the money manager is who is doing this. Do you find that just because something is and I'm thinking about mutual funds, just because a mutual fund is a no load or no commission for doing it, do you get the same return as you would for some companies that have a larger fee or load?
What I find is this, Andre, and I think I can expand beyond mutual funds and give you a much broader and I think accurate answer. I find that, number one, the old adage is generally true in life. Generally, you get what you pay for. There are instances where, whether it's a mutual fund or some other product, the fees are exorbitant, and those should be summarily stricken out. But I think the fact of the matter is that most people generally, when it comes to fees, let the tail wag the dog. Nobody is running a philanthropy. So a no-load fund still has certain management fees. 12B1 funds, it's a different type of fee structure. There are fees there. I think fees are certainly worth weighing in to the equation. But I'm really, as long as a person's fee is reasonable, and generally it seems to vary somewhere between, I don't know, depending upon the amount of money, I don't know, 0.5%, 1%, 1.5%. It depends on the product you're buying. It's somewhere in that range. I'm more concerned if, for instance, someone were charging a 1% fee, whether it's a mutual fund or an individual. I'd say, Joe or Sally, okay, I understand you're going to charge me 1%. What are you going to do with the other 99% to justify that? And if the result with the 99% is a good one, I'm happy to pay for that individual's services, whether it be a fund or a managed account or whatever the case may be, any sort of, and that's any sort of service. It's not restricted to financial products. Somebody's always charging something. Nobody's running a philanthropy, and I think you really want to get an understanding of, after the fee is charged, what kind of results can I realistically expect from the amount of my money that's going to be invested? And if the results justify the fee, I think you've answered your question.
Jim, we're out of time. I hope you come back.
Thanks, Andre.
Thanks, Jim. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. Now for a look ahead for market information for next week. But first, what financial newspaper began publishing on this day in 1889? We've got the answer in just a moment. Well, what financial newspaper began publishing on this day in 1889? The Wall Street Journal. Volume 1, number 1. The first issue began publishing on this day, July the 8th, 133 years ago today. Well, the first half of the year just ended, and how will the remainder of 2022 look for the stock market? Next week, we're going to be talking with economist and author Steve Moore. Now, Steve writes numerous op-eds for the Wall Street Journal, Washington Post, the New York Times, and he also just published a book on inflation with publisher Steve Forbes, who we've also had on the show. And he was also part of the Trump administration, and he's also the architect of the 2017's Tax Cuts and Jobs Act. Today, the federal Treasury is seeing a record income coming into the Treasury, and a lot of it has to do with that. So how does this week's job numbers for June look to avoid a recession, or is a recession inevitable? We'll find out. That's next week with economist and author Steve Moore. And as a reminder, we repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that's our show for this Friday, July the 8th, 2022. I hope you enjoyed it. My thanks so much to Jim Spiro with Morgan Stanley for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. Remember, you can always follow us on all the social media, on Facebook, now known as Meta platforms, on YouTube, on Twitter, and WYES.org. So, have a great weekend and a productive week as well. I'll see you next week. For Wall Street Wrap Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.